Today's Who Said What episode is going to be a little different. I'm not going to pick a comment from a business leader or a fund manager and contextualize things around for you. We recently started something called a subtext. The idea behind it is pretty simple. There's a lot of interesting thinking happening in markets, regulation, energy, technology, and everything adjacent to all of that. And most of it never reaches people who aren't deep inside those worlds. So we've been trying to create a place where you can read extremely high quality opinions from people who are actually in thick of it. We have some exciting stuff lined up there and we'll start releasing it next week. The other thing we've been doing for a while on Subtext is something a little more personal. It's called What We're Reading, where every weekend we send a long piece as to what all of us at Markets by Zerodha are reading. I wanted to experiment and see if this is something you would like, and if it is, let me know in the comments below. In the last edition, all of us went through a bunch of interesting reads, all of which you'll find links to in the description below. I'm going to walk you through a few of them here today. But if you want the full piece, it's in the description and it's worth reading in full. I'll start with mine first. I've been reading a piece by Ed Zitron, who runs a newsletter called Where's Your Ed At? It's fun, it's a little provocative, and he regularly goes places that mainstream tech journalism mostly won't touch. This piece is called The Beginning of History, and it starts where you wouldn't expect a piece about the AI bubble to start, the Strait of Hormuz. The Strait of Hormuz is a 24-mile wide channel between the UAE and Iran. That's it, 24 miles at its narrowest point, and roughly 20% of the world's oil and LNG flows through it every year. By now, of course, you know all of this. At the end of February, Iran's Revolutionary Guard closed it off, telling merchant ships that passage was no longer allowed. Now, Iran can't legally do this. It's international waters governed by UN convention, but merchant captains don't particularly want to find out how seriously Iran means it. Neither do their insurers, and so the tankers are sitting put. Now what that means for oil prices is fairly direct. We saw a 30% overnight spike with the price of a barrel crossing $100 for the first time since 2022. And oil prices feed into everything. Shipping cost, construction materials, basically anything that has petrochemicals in it or needs to be moved anywhere. Now when inflation goes up, central banks raise interest rates to cool things down. And here's where AI bubble enters the picture. The entire infra of AI, data centers, chip shipments, the VC funds backing startups, the private credit sitting on top of all of it, runs almost entirely on debt. When interest rates rise even by a point or two, financing the hundreds of billions this bubble requires gets significantly more expensive. Investors in VC funds can suddenly earn better returns with far less risk by parking money in a government bond. Now the debt spigot, which has been running wide open, starts to tighten. Then there's the physical layer. The data centers powering AI are largely gas powered, and natural gas is up as much as 50%. Flying racks of NVIDIA chips from Taiwan to Texas becomes more expensive. Every contractor building these facilities will pad their fees to the account for their own rising costs. The squeeze comes from every direction at once. Now all of that is about external pressure. Macro forces making the bubble more expensive to sustain. But Ed's second argument is different and in some ways worse. It's about whether the foundation that's supposed to justify all of this spending was ever real in the first place. Press reports have been citing Anthropic's annualized revenue at anywhere from $14 billion to $19 billion, but those figures take a single month of revenue and multiply it by 12. Then a court filing from Anthropic's own CFO, submitted as part of a suit against the Department of Defense, stated that Anthropic's lifetime revenue as of March 9, 2026 is $5 billion. When Zitron adds up all the monthly figures that have been publicly reported, they already exceed $6 billion, which makes the $5 billion lifetime figure and the $4.5 billion annual figure that's widely been cited for 2025 very hard to believe. His broader point is that journalism keeps reaching for the same historical comfort. .com, crypto, now AI, and in each case building a narrative around the assumption that it will work out because things have worked out before. He thinks that's lazy and that this era is different enough that the comparison fails. I'm not sure I have fully settled on that view yet, but the Anthropic numbers alone make this worth reading. Now Pranav from the team has been reading about two things and I'll tell you both. The first is a Paul Graham essay called The Brand Age. He starts with the Swiss watch industry. After World War II, the Swiss were the best in the world at making watches. Then the Japanese started closing the gap, and within a generation, they had caught up, and a lot of Swiss manufacturers went bankrupt. The ones that survived did something interesting. They stopped competing as tool makers and started competing as jewelers. They sold you not a watch but a brand, and that brand saved them. Paul's conclusion isn't a comfortable one. He argues that brand is often more important than actually making a good product. That good design, sensible, functional, honest design can actually be bad for branding. That good branding might need to be loud, which is the opposite of what anyone with taste would want to make. He's not celebrating this. He's just describing it plainly, which is what makes it sting a little. However, one of our own stories for the Daily Brief might not entirely agree with Paul Graham. Last year, we narrated a tale of how the company that followed this playbook for natural diamonds to the highest possible extreme is now fighting for bare survival. And that's because its fundamental business is becoming more commoditized every single day. The second thing Pranav has been reading is Ruchir Sharma in the FT on China's growth targets. Now, most countries discover their GDP growth rate after the fact. The year ends, the data comes in, and you find out how you did. China does it the other way around. They announce a target and they hit it. Ruchi's point is about what it costs to do that and who ends up paying. See, hitting a target year after year requires constant investment, whether or not that investment makes economic sense. You build factories, you build capacity, you produce. Over time, this creates a structural glut. Too much of everything produced at a cost lower than anyone else can match. Now, the first version of that reaches you as the cheap Chinese goods that have made life genuinely more convenient. The second version is the hollowing out of industries in countries that simply cannot keep up. That's bred a deep resentment across much of the world. The targets make China's problems the world's problems, and there's only so long the world will absorb that quietly. And then there's what Money has been reading, which I think is one of the most interesting things in this edition, a long piece by Kevin Zhu on China's open source software history. Now, Kevin is someone worth knowing. He led GitHub's international business strategy, worked at the White House during the Obama years, and runs a newsletter called Interconnected that covers Chinese tech and entrepreneurship. His piece starts from a question that I suspect most people haven't thought to ask. DeepSeek, Minimax, Kimi, the Chinese large language models that have been making headlines, are all open source. Now, did that come from nowhere, or is there a much larger, longer story to this? Now, it turns out it's the latter. China's open source community wasn't created by a government mandate. It grew the same way it did everywhere else, spontaneously from the bottom up, from people who cared about it. The government only truly committed to it once they realized how strong the movement already was and how much it could add to China's economic and technological strength. Now, the first big inflection point Kevin traces is Alibaba. They were entirely dependent on Western providers, Oracle, IBM, for their server infra. As their e-commerce businesses scaled, those bills kept growing. So Jack Ma brought in someone to fix it. A man named Wang Jian, who had a doctorate in psychology and notably did not know how to code. Wang Jian ended up playing the biggest role in helping Alibaba wean itself off that dependency. What makes the piece stick is that it doesn't treat open source as just a software story. It puts it inside a frame of national security and sovereignty. Who controls the tools, who can cut it off, and who can't. Money says he doesn't like most of the long essays that get published on Twitter these days, but this one is a gem. And I would agree. That's it for this episode. Do let me know if you like this and if we should do more of this.